Have you ever wondered how professional investors value a stock? Well, today I'm going to teach you all about valuation. What's up everyone, my name is Ben. I'm a former JP Morgan investment banking analyst and welcome to Rare Liquid, the best channel for tech investing. Like I mentioned in my last video, I'm going to be using Coupang as an example for this valuation lesson. So if any of you guys are thinking about buying the company after its recent IPO, hopefully this is a helpful video for you. But as always, remember that I am not a financial advisor, so please treat all content as entertainment purposes only and make sure to use it just as like a starting point for your own research. All right, with that said, let's get started. The first thing I want to do is go over a few key terms that you need to know. The first concept is enterprise value, which equals your market cap plus debt plus non-controlling interest plus preferred stock minus cash. If most of these are totally new concepts to you, don't worry, the main ones you really need to know are market cap, debt, and cash, because the other two are a bit abnormal, but I'll leave a definition of these in the comments below. Equity value, which is also known as your market cap, is pretty simple. It's just your share price times your number of shares. Your debt and your cash are probably self-explanatory. If a company borrows money, then it has debt. If it doesn't, it has zero debt, and the company can also have a cash balance. But what may not be clear is the difference between enterprise value and equity value, and I think the best way to really explain this is through an analogy. Imagine that you're driving, you see a beautiful house, and you go up to it, knock on the door, and tell the person who lives there and owns the house, hey, I want to buy your home. Let's say the homeowner was looking to sell and he bought the house through a mortgage with the local bank for $100,000. This $100,000 is the enterprise value. The homeowner says that he has put in $30,000, which is the amount of equity he put into the home, and that's pretty much akin to a company's market cap. This leaves the mortgage loan remaining on the home of $70,000, and that's equal to a company's debt. Lastly, you subtract out your cash when calculating your enterprise value because basically a company could use it to pay off its debt. Now I'll be moving on to some of the other key terms I'll be using throughout the rest of the video. First, there's net debt, which is just your debt minus your cash. Second is LTM, which stands for last 12 months. Gross margins is your gross profit divided by your revenue. Gross profit is your revenue minus your cost of goods sold. And lastly, there's EBITDA, which is your operating income plus depreciation and amortization. And this is what many finance people use as a proxy for how much cash a company is generating. To go over all of these with an example, imagine you have a t-shirt selling business and you sell t-shirts for $10 each that cost $2 to make, and you're selling 10 of them. This gives you a total revenue of $100. Your cost of goods sold is 10 shirts times $2, so $20. Your gross profit is $100 minus $20, which gives you $80. Your gross margin is $80 divided by your revenue of $100, which gives you 80%. And let's say operating expenses, which include things like sales and marketing and wages to employees, costs $60. So your operating income is $80 minus $60, which gives you $20, and this is also known as your EBIT. Then, let's say that you have $10 in depreciation expense, and so your EBITDA is $20 plus $10, giving you $30, and thus your EBITDA margin is 30%. All right, now that you know the terms I'll be using, I'll show you now how to value a company using Coupang as an example. But there are two things I want to mention beforehand, and the first is that there are multiple different ways to value a company, and they range in complexity. The four main ones are the discounted cash flow analysis, leveraged buyout, transaction comps, and trading comps, and we're going to only be covering the last one. I decided to talk about trading comps because it's a really simple, basic, fundamental analysis that anyone can do. The second thing I want to mention is that you can find all of the data I'm about to show you on financial data aggregating sites like Yahoo Finance or wallmine.com, but it's important to note that a lot of times these websites are incorrect, so I actually had to manually go and change and fix some of the numbers that you're going to see soon by going into the company's actual financial filings. Okay, so back to trading comps. Trading comps is a relative valuation methodology in which you compare the financial figures amongst a set of similar companies to figure out what your target company is worth. The first step involves getting a group of similar companies together, which oftentimes can be the hardest part because it really requires you to understand an industry. For our purposes, you can see the list of companies I chose and will be comparing against Coupang. And all of these companies are pretty big e-commerce players, but many also have other divisions, and these companies are also located all over the world. This is actually one of the problems with trading comps. You'll never really get an apples to apples comparison when you're comparing companies because they differ so much in geography, management teams, different products that they sell. And so it's not really a perfect analysis, but it is one that really helps you figure out and give one data point of what valuation your company should be at. The second step involves gathering financial information, which are all the ones I explained earlier on in the video. The financial information can completely differ, so these aren't the ones that you have to have, but they're just the ones I chose for the video. But the one metric I didn't explain earlier, and honestly the one that is the most important, are multiples, which is on the very right over here. There are many different kinds of multiples, but the one we're using today is enterprise value divided by last 12 months revenue. There are also ones like enterprise value over EBITDA, and you probably also heard of PE multiples. But basically what these numbers represent are how many times investors are currently willing to pay for every dollar of revenue earned in the last 12 months for each company. So for Alibaba, investors are willing to pay $6 for every $1 in revenue earned, while for C, investors are willing to pay nearly $26. As you may have already deduced on your own, the higher the multiple, arguably the more expensive or overvalued a company is, but of course there's a lot more to it than that. When a company is trading at a really high multiple, usually it's a sign that investors really believe in the company and believe that there's a lot of future growth ahead and that the company will outperform. At the same time, there are times when investors pile too much into one stock and the valuation gets really stretched. And so that's when you want to stay away from a company that has a multiple that you think is way too high. Another thing I want to note is that usually for trading comps, you want to be always looking into the future, not the past. Right now, we're looking at last 12 months sales because looking into the future and getting consensus estimates, you have to pay a lot of money for that kind of information. And frankly, the average investor like you and me, we don't have access to that information. The third step is to compare the financial figures against one another and understand what's driving them, and this is really where there are no clear-cut answers. So let's go through each of these columns one by one. First off, we have our market caps, and in an ideal world, you want to have companies that are around the same size as the company you're valuing, but most of the time that's not really possible. In our case, Coupang's market cap is $87 billion, and so Amazon, Alibaba, and Samsung are way bigger than Coupang, so when I'm looking at these numbers, I'm mentally putting more weight into the others on the list. In our next two columns, we have net debt and enterprise value, which I discussed earlier, and what's important to note here is that sometimes net debt makes a big difference like it does for Alibaba, but not so much for companies like Mercado Libre. In the next column, we have revenue growth, and as you can see, Coupang has the highest amongst all its peers besides C, which is a great sign for Coupang. But at the same time, you don't want to get too carried away with the revenue growth because the size of that company and their revenue really matters. When you're a much smaller company, it's much easier to grow faster, just as how if you had a friend who made $100 million from $50 million, that would be a lot more impressive than if someone made $1 from 50 cents. One other thing I want to point out is that Coupang generated nearly all its revenue from e-commerce and Coupang Eats, which is food delivery, and last year COVID really boosted that space. And a lot of these companies received a similar boost, but some more than others, and you just can't expect these kinds of growth rates moving forward. In these next columns are where things get pretty interesting. We see that Coupang has the lowest gross margins and EBITDA margins amongst its peers, which is a bit concerning. What is especially concerning is that when a company scales, it should become more efficient, and Coupang is already generating more revenue than C and Mercado Libre, but has worse margins. It's helpful to compare these numbers because just by looking at them, you can see that you really need to dig into why Coupang's margins are so much lower and what you can expect in the future. Now we move on to the revenue multiples to tie everything together, and I'll go through a few examples to show you how I would think about them. Amazon earns 30 times more revenue than Coupang, and so it's crazy that the company grew at 38%. The company also has really solid margins, largely in thanks to AWS, and so a 4x sales multiple seems pretty reasonable compared to the rest of the peers. Alibaba also has pretty outstanding numbers and looks attractive, and if it was a US-based company, the sales multiple would probably be a lot higher, but due to the risks in China, that's probably why the stock has been hammered lately. C and Mercado Libre are two pretty good peers, but they're based in Southeast Asia and Latin America respectively, so totally different markets. But what's important to note here is that these companies are trading at really high multiples compared to Coupang. And to me, even though their margins are higher, I think the story is more about the total addressable markets of these companies rather than really the numbers you see here. Coupang right now is limited to the Korean market, which has around 50 million people, while Southeast Asia and Latin America have well over 600 million people each. Korea has one of the highest internet and smartphone penetrations in the world, while Southeast Asia and Latin America, technology in those areas, penetration is still growing rapidly, and so investors may be justifying a high multiple by just saying these markets are going to grow sustainably in the future, while for Korea, Coupang already has 15 million of the 50 million total number of potential customers, and so unless Coupang really diversifies and enters into new markets, the growth may be limited, and that's why you might see a lower multiple for Coupang. The last two I want to discuss are Naver and Kakao, which are two Korean-based companies. These companies are trading at much higher multiples than Coupang, which may suggest that Coupang is trading at an attractive value. But there is also a bit of a challenge comparing these companies because they have higher EBITDA margins and also trade on the Korean stock market, while Coupang trades on the New York Stock Exchange. Still, I think that they are good reference points, and this leads me to the last step of trading comps, which is determining your implied valuation. I'll next be calculating what I think is a fair price for Coupang. But really quickly before I do, if you guys want an Excel spreadsheet sent to you each week with a bunch of data for high growth stocks organized for you, consider subscribing as a Gigabyte patron. I'll be upgrading this sheet over time, and later on it'll include a trading comps and DCF template so you can run your own analyses. Anyway, back to the topic at hand. To calculate Coupang's implied share price, what I'm doing is multiplying my operational financial metric, which in this case is last 12 months revenue, and multiplying it by the multiple that I think the company should be trading at. For me, I'd be more comfortable to start buying if Coupang traded in the range of 4 times to 6 times, which implies a share price of $28 to $42. I would aim to start about 25% of my position at 6 times revenue if Coupang ever went down to $42, and dollar cost average down if the price keeps falling. My reasoning for a 4 times to 6 times multiple is that Coupang really has a lot of issue generating cash. Coupang's $11 billion is pretty impressive, but you have to remember that they're pretty much just helping merchants sell their items and they record that as revenue, versus companies like Kakao and Naver, which also have e-commerce divisions, but also sell products that require things like subscription and other services that are a little bit hard to earn revenue, but has a better, healthier margin. In addition to this, Korea as of now is currently limited to just the Korean market. And so as an investor, what I'd like to see before justifying a higher multiple or the 7 times multiple it's trading at right now is some signs or execution that the company is able to create a really cash generating business like Amazon did with AWS, or that the company is able to successfully execute in another country to pretty much just open up and increase its total addressable market. Now, with all this said, as I did mention in my previous Coupang video, I am a customer myself, and I think the company offers the best service in all of the e-commerce competitors that are out here in Korea. And so I think that especially given that the company has been able to already reach 15 million customers, is probably going to reach more than 20 million in the coming years. There's just going to be so much opportunity for the company at a huge scale like that to launch different businesses and potentially dominate in the different industries that they enter into. And so I'm willing to take the risk of entering at around a 6 times multiple, and if it drops even further than that, I'll probably increase my position. I do have to add that this is all a pretty simplistic analysis, and so if I wanted to get a better hold of valuation, I probably would want to run a discounted cash flow analysis on Coupang. If a video on discounted cash flow or if this video was helpful, please let me know in the comments below so I know to make more of these types of videos. With that said, that wraps up the video. As always, thank you so much for watching. Hopefully I catch you in the next one. Thanks so much. Peace out.